Most people think buying a home in Kansas City is just the price of the house and the mortgage payment. And that's exactly why buyers get blindsided, because the mortgage payment is only one piece of the real monthly cost. So in this video, I'm gonna break down the full Kansas City home buying cost picture in plain English. What you'll pay every month, what you'll pay up front, and the stuff that almost nobody budgets for until it hurts. I'm also gonna answer the question I hear constantly: how much house can I actually afford? Because that's what buyers really want to know. Quick intro before we dive in. I'm Joe Nelson. I'm a 21-year Air Force veteran, a Kansas City realtor, and a fully licensed mortgage professional. That combination lets me help buyers understand not just the homes and neighborhoods, but the financing and the real monthly cost too. And our team has earned over 1,100 Google reviews from Kansas City clients. Now, let's get into the full cost breakdown so you can shop with confidence. Let's start with the big one, principal and interest. What most people call the mortgage payment. This is based on your loan amount, your rate, and your term. And I want you to remember this line because it changes everything. The list price is not your payment. Two people can buy the same house at the same price and have totally different payments depending on down payment, rate, and loan type. So when you're shopping online and you see a price you like, don't let your brain decide, I can afford that, until you've built the full monthly number we're gonna talk about today. Next is property taxes. And this is one of the biggest reasons Kansas City payments can swing more than people expect. Taxes can vary across the metro and sometimes even within the same general area. And here's what trips people up. They'll look at a home price and assume the payment will be similar to another home they saw at the same price. But taxes can push that monthly number up fast. So when you're estimating affordability, don't guess taxes. Ideally, you're looking at a realistic estimate for that property, because if you don't, you can end up falling in love with a home that looks affordable and then the real payment comes back higher than you planned. Third is homeowners insurance. Insurance isn't just a checkbox. This is a real monthly cost, and it can vary more than people think. Roof age, home age, prior claims, coverage limits, and certain features can change your premium. Kansas City has a lot of older homes and a lot of different house styles, so you really want to get an insurance quote earlier in the process than people normally do. If you wait until the end, sometimes you find out insurance is higher than expected, and now your payment is outside of your comfort zone. Fourth is HOA dues or condo fees. This matters a lot for condos, townhomes, and certain neighborhoods who have monthly fees. And the key isn't just the number, it's what you get for it. Some HOA or condo fees include things like exterior maintenance, water, trash, amenities, sometimes more, and sometimes cover very little. Two homes at the same price can have totally different monthly costs just because of the HOA fees. So when you're comparing homes, don't compare price only, compare the full monthly cost, and always ask what the fee covers and whether it has been increasing. Fifth is utilities. This is the stealth monthly cost that people don't think about. Utility costs can jump depending on the size of the home, how efficient it is, and whether it's an older home with older windows or less insulation. If you're moving from an apartment into a house, it can be a surprise. Even if the mortgage payment is manageable, utilities can make total monthly costs feel tight. My advice is to build in a utility cushion in your budget so you're not stressed every month when the bills hit. Now, the sixth one is big and one people ignore: maintenance and repairs. Even if a home is in great shape, there are ongoing costs: filters, servicing, HVAC, landscaping, small fixes, and then eventually bigger items like roof, HVAC, water heater, appliances, sometimes plumbing or electrical upgrades depending on the home. The mistake I see buyers make is a budget where the payment is so tight, there's nothing left for the fact that homes require money over time. So treat maintenance like a real monthly line item. Even if you start small, start something, because when things break, you don't want that turning into a credit card debt or major stress. So here's a quick way to think about the real monthly cost of owning a home in Kansas City. You take your principal and interest, you add monthly property taxes, and then homeowners insurance. Then of course HOA, if there is one, and you add a utilities cushion and a maintenance cushion. That final number is what you call your real payment. And now let's answer the big affordability question. How much of your income should the payment be? There are a few different guidelines out there, and I'll tell you the most useful way to think about it. Dave Ramsey's guideline is that your total house payment, not including maintenance and utilities, should be no more than 25% of your monthly take-home pay, including taxes and insurance and anything like HOA and PMI. And he recommends a 15-year fixed mortgage for that guideline. A lot of people use the more traditional 28-36 rule, which is basically 28% of your gross monthly income for housing and 36% of your gross monthly income for all combined monthly debt. Again, not including utilities and maintenance. Here's the important part. These are guidelines for a reason. They help you avoid being house poor. Because yes, lenders can sometimes approve a higher debt to income ratio than what feels comfortable in real life. But approval is not the same thing as affordability for your lifestyle. So I want to give you a super practical way to estimate your comfort zone. Step 1. Decide whether you want to use a conservative rule like 25% of take-home or a more flexible rule like 28% of gross income. If you want the safest starting point, use the conservative one. If you're trying to understand what lenders might allow, the gross income rule helps you estimate. And here's a shortcut. If you take your gross monthly income and multiply it by 0.28, that gives you a rough housing payment target. If you take your monthly take-home pay and multiply it times 0.25, that gives you a rough conservative target. And whichever of those two numbers is lower, that's usually the payment that feels more comfortable month to month. Let's do quick examples so you can picture it. If your household makes $6,000 per month gross, 28% is about $1,680 for the house payment. If you're bringing, say, $4,500 after taxes and deductions, 25% of take-home would be about $1,125. Notice how big those differences are. That's why people get confused online. One calculator uses gross, one uses take-home, and it can sound like you can afford way more house than you actually want. Another example, if you make $10,000 per month gross, 28% is $2,800. If you take home $7,500, then 25% is $1,875. Again, huge difference. So the question isn't just what can I qualify for, it's what payment lets me live my life and still save money. And one more reality check. Don't forget the 36% part of the rule. That means your total monthly debts, car payments, student loans, credit cards, and the house payment ideally stay around 36% of your gross income. So if you already have a big car payment or other debts, your comfortable house payment might be lower than that 28% number. This is why I recommend building the real payment first and then checking it against your income, not the other way around. Now let's talk about upfront money, because this is where people confuse down payment with cash to close. Those are not the same thing. You might have earnest money, inspections, appraisal, and closing costs. Depending on the situation, there can also be prepaid items like insurance and taxes that factor in. The key is this. Even if you have a low down payment option, you still need to plan for the other costs of getting to the closing table. That's one of the biggest reasons buyers feel stressed late in the process, because they only planned for down payment and then all the other pieces start showing up. So here's how to use all of this when you're house hunting. Before you go see a home, or right after you see one you really like, build your real payment: mortgage, taxes, insurance, HOA. Don't forget some utilities and maintenance cushions. Then compare that number to your income using a guideline you're comfortable with. Conservative like 25% of the take home, or more flexible like 28% of the gross. If it feels good, you're in a safe zone. If it feels tight, the home may be too expensive for your lifestyle, even if a lender says you qualify. This is how you avoid heartbreak. If you want to run your numbers the same way I do with clients, I've got a great affordability and payment calculator inside the Manifest with Us app through Leader One, the mortgage company that I work with. Just comment KC and I will reply with the link, or call or text the number on the screen and I'll send it over. Once you run your scenario, text me a screenshot of your results and I'll help you sanity check the payment, tighten up your comfortable price range, and even point you toward a few KC areas that fit what you're trying to do. And if you're a veteran planning to use the VA loan, tell me that when you reach out so I can make sure you're using the VA-friendly settings and strategy. If this was helpful, hit like, subscribe, and I'll see you in the next one.